Welcome to Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. Earnings season for the banks is heating up. Bank of America, Wells Fargo, Citigroup, they're all out with results ahead of the open. Bank of America and Wells Fargo seeing profits jump at the end of the year, powered by strong trading revenue, but the stocks are under pressure ahead of the open. Meanwhile, Citigroup looking higher after a mixed report. And looking at the broader market, stocks are losing more ground after Tuesday's rout, but the big moves we're watching are in commodities. Oil, gold, silver, they're all rallying as investors eye geopolitical tensions. Gold and silver are trading near new records. And a fresh round of economic data showing some consumer strength. November retail sales topping expectations, driven by holiday shopping and auto sales. But the inflation picture looking a little murky. The producer price index shows wholesale inflation rose more than expected in November from a year ago. Let's get a check in on stock futures right now. We are seeing futures under pressure across the board, continuing some weakness that we saw yesterday. Right now, Dow futures indicating a drop of about 0.3% at the open. The S&P futures pointing to a drop of about 0.4%, and it looks like NASDAQ futures leading the declines off by more than 0.5%. A lot of the trading action this morning has to do with what's going on with the big banks, because those big bank earnings are rolling in. Bank of America, Citigroup, Wells Fargo, all reporting this morning. And joining me now, markets and data editor Jared Blikre and Ann Berry, Threadneedle Ventures founder. Jared, let's start with you. And I want to sort of go one by one here because we have some idiosyncratic situations at the banks. And so let's talk about Bank of America first. And, you know, what sort of looked like a mixed report from that bank.
Yeah, so we can go down the line here. Net interest income, that's kind of the spread between the short and longer term interest rates. They want to borrow at the lower end and they want to lend at the higher end. That was actually up, so that to $15.75 billion. They guided for the full year up 5 to 7%. That was a plus. Equities trading, that stock trading, that was a standout too. It was up 23%, their best fourth quarter ever. Looks like they're controlling their expenses. Their expenses were $17.4 billion, up almost 4%. And when it comes to operating leverage, and that's just how much profits are growing versus expenses, they were saying it's going to be 200 basis points for the full year. Now, some of the negatives, it looks like their fixed income trading missed, and so we just said that the stock trading was a boon, but the fixed income trading, which is bonds, that was $2.52 billion. There was estimates of just a little bit higher, $2.62 billion. The stock really hasn't performed as well as many of its peers over the last few years, and of course they have rate sensitivity and policy uncertainty with respect to that 10% credit card cap that was proposed yesterday, and we can get into that. That's kind of its own story. Yeah. I do have a couple of comments here. As in terms of mergers and acquisitions, the CFO says he feels very good about our pipeline for the next year ahead. Consumer resilience, this is a big theme when we talk about banks. The CEO, Brian Moynihan, saying consumers and businesses proving resilient, bullish in 2026. And then on that credit card, we did get a comment from the CFO. Don't have anything to add. So
yes, on the whole credit card debate. Yes, I'm sure we'll be talking more about that throughout the show, though. And Ann, what was your impression of Bank of America earnings, sort of in your world, which is the world of venture capital, private equity, although you have feet in a lot of different worlds. I was struck by the fact they said they had an 18% drop in revenue from equity issuance. But as Jared just mentioned, there's some optimism about that turning around this year.
Well, don't forget, equity issuance was impacted by the government shutdowns. We saw IPOs basically grind to a halt in the fall of last year as a result of that. And then the spring emergence, the spring wave of IPOs we've been expecting got slowed down too, because the Liberation Day tariff sort of chilled the market a little bit as folks wanted to wait to see how that would play out in terms of equity valuations. I think that's pent up issuance, Julie. I think it comes back in 2026. So look, I was optimistic about Bank of America. I actually added that position to my public portfolio last week. And I actually remain optimistic and positive that Bank of America is well positioned when we see capital regulations loosening in this year. That's something that we're expecting. There was a big ruling by the FDIC in November to ease key leverage requirements. So I think there's upside here.
What do we think is responsible for the drop in the stock, Ann? Is it that fixed income disappointment, perhaps?
No, I think there's a sentiment issue right now around this credit card debate. And I think that the names like Bank of America have been more exposed because consumer services, right, retail banking is a really big part of that business versus others like a Goldman Sachs, for example, that skews much more heavily towards corporate banking. So I think until we get some clarity on this credit card cap announcement. I was watching Senator Elizabeth Warren talking about her conversation with the president on that topic this morning. I think we're going to see sentiment hit some of these key names, but I'm willing to ride it out.
Let's talk about Citigroup. Speaking of sentiment, they have, of course, a big credit card portfolio. But Jane Fraser, the CEO, has also been working really hard to beef up areas of the bank that have not historically been strong. Financial advisory, for example, the wealth channel. She's done some hiring in that department. And Jared, it looks like at least some of those efforts have been paying off.
Yes, and that's one of the few banking stocks that we're seeing up right now, and especially after yesterday when JP Morgan was down 4%. Let's go through some of the line items here. Fixed income, that was a beat. Again, that's bond trading, 3.46 versus 3.29 billion. Their markets overall were 4.54 versus 4.45 billion expected, and but their stock trading was a little bit of a disappointment there. The net income surprise, that was 15.6 billion, 6.7 billion versus 14.89, so nice beat there. They guided ex markets net interest income 5 to 6% up in 2026. Services strength, that was another plus. Investment banking better than expected. You were just talking about that. Advisory was up 84% to 649 million. Banking was up 2.21 billion versus 2 billion. And then credit was better. Total cost of credit was 2.22 billion, and that was down 14% year over year, but it beat the 2.54 billion estimate. And as far as the turnaround scoreboard is concerned, the CEO is committing 10 to 11% of returns on tangible common equity target for 2026. So that kind of adds to that momentum narrative. And I think that kind of encapsulates some of the biggest points there.
Yeah, those are the highlights. And Ann, you said you added Citigroup as well to your public portfolio here. Validated, at least on the day, right? What's your assessment of the progress they have made on some of the measures we were just talking about that Jane Fraser has really invested in?
Well, I think Jane Fraser is a great operator, and I think she's gone in there. She's been extremely disciplined about removing costs, even as recently as earlier this week. And here's one thing I would also say about Citi. It's really got great brand recognition in terms of its retail offering. As you said, Julie, at the top, I've grown up in private equity. And when I think about the number of banks I've worked with over the course of my private equity career, I think it's underestimated the strength of Citi's M&A advisory franchise when it chooses to use its balance sheet to support big M&A deals or to support big leverage buyouts. Citi is actually one of the go-to banks for the industry. And so I think it's pretty well positioned as we look ahead to a year that I think will still be marked by strong M&A transaction volume. And again, I think once IPOs reopen, Citi is also another one of these names that's positioned really well.
All right, we got to talk about Wells Fargo here. This is the worst performer of the three that we've been talking about this morning. And Wells, as we know, has been struggling for quite some time. And here again, we have numbers that weren't quite up to snuff. And it's in part, they cut costs, but those cutting of costs costs them money. In other words, they laid off a bunch of people, but when you lay off people, you pay them severance. And so they have these short-term severance costs.
Yes, so that was $612 million, a bit bigger expense than analysts thought. So the total expenses were $17.73 billion versus $13.6 billion. Not a huge overage, but still it kind of adds to these incremental misses. And the big miss was on revenue. So that's a headline number, $21.29 billion versus the larger expectation of $21.64 billion. Also missed on that key net interest income statistic that I was talking about, $12.33 billion versus $12.43 billion. And let's see here. Investment banking was also a little bit softer. They're trying to really turn things around and kind of lean into this, but investment banking fees were $716 million versus $795, despite their M&A rank improving to 8 from 12.
So, okay, and what's fascinating to me about Wells Fargo is the stocks actually performed pretty well over the past year. Many of the banks have done well over the past year, and yet here again, we got a quarter that was sort of disappointing. Do you think, though, that investors will end up giving Wells Fargo a break?
I don't think they will. I certainly wouldn't. And here's why, Julie. I think Wells Fargo is having a bit of an identity crisis. Right? It was known for being a staple in the mortgage market. It retreated from that. It had a reputational damage done to its franchise in the housing market. And what lending it has done has remained subpar in terms of performance. And when you look at Wells Fargo's brand positioning, when you think about what it is known for, it's really hard to think about what comes top of mind for that particular bank. And so I don't think that there is going to be a Wells Fargo that catches a break until we see a Wells Fargo that has got a clearly articulated strategy with a very clear point of view coming from itself as to where it wants to play and wants to win share. And I just haven't heard one yet.
And let's take a step back here. Jared, I would love it if you could pull up the Wi-Fi Interactive and take a look at bank stocks, because bank stocks have been killing it over the past year, by and large, right?
Yes.
We've just seen incredible performance from them. And, because of that, there were some pretty high expectations going into this reporting season.
Right. What we're looking at right now is the Wi-Fi Interactive heat map on big banks, and all these returns are over the last year. So you see JP Morgan in the upper left, just by way of reference, up 27%. Here's Citigroup up 60%. Wells Fargo, we were just talking about them, up 33%. Bank of America up 21%. And Goldman Sachs, we're going to get those results tomorrow, up about 67%. If I throw on the pre-market quotes, those are in those little rectangles. You can see a lot of red to the left, and that just kind of indicates that that the results were more or less disappointing for investors this morning. The exception, is Citigroup in the upper right, which I'm trying to circle here. That is up 1%. But overall, we've heard analyst after analyst just come into the new year very bullish on the banking picture. Part of that's deregulation, part of it's the Fed lowering interest rates. You put it all together, and they've just done well over the last year.
I mean, then you have a hiccup with this whole credit card fee cap threat. But we'll see if that ends up coming to fruition. And I did want to sort of zoom out also and ask you just more generally about the markets right now. Obviously, as you said, you've been seeing some opportunity in some of the banks. But more broadly here, where there is a lot of sort of DC-generated headline turmoil and volatility that's coming out, how are you keeping your focus and what are you focused on?
Well, it's been a tricky one. Many of us, came out of 2025 end of the year. We've done our tax loss harvesting, so we may be sitting on some cash and figuring out what to do with it. And I think, Julie, where I'm focused is strictly on valuation. And to bring it back to the bank stocks, if you look at the JP Morgan and the Goldman Sachs, both of which I hold, ended up last year trading over 2 times book value, which is really high compared to historical valuation levels. So much so that I think Jamie Dimon said about his own stock back in November. I mean, it seems pretty highly valued to me, I think, was sort of paraphrasing what he said. And so trying to really focus now on multiples of EBITDA as a proxy for free cash flow. So I'm looking a lot harder at things like the health insurance companies, trying to look at some of the bigger tech names, looking at a multiple of free cash flow, but also trying to be circumspect about valuation. And I'm looking at industrials again. I think some of them sort of rode this wave of being part of this AI hardware trade, and I think some of them are beginning to come back down, but probably won't do so at a point that's interesting until after their earnings come out, kind of February, March.
And good to see you. Thanks so much, and thanks, Jared. Coming up next on Morning Brief, we'll bring you today's top trending tickers, count you down to the opening bell, and we'll be talking oil and Iran next. Now time for some of today's trending tickers. We are watching cybersecurity stocks, BP and Tesla. First up, let's look at cybersecurity stocks. China is reportedly banning the use of roughly a dozen firms from the U.S. and Israel. That's according to Reuters, which says Chinese authorities have told domestic companies to stop using cybersecurity software from companies like Palo Alto Networks, Fortinet, and Checkpoint Software. It's unknown how many Chinese companies have received this notice, Beijing citing national security concerns as the reason behind that move, and those stocks are under pressure. Next up, BP flagging investors about a hit from write-downs ahead of its earnings report next month. The company is expecting to take as much as $5 billion in write-downs from its transition business. These charges primarily attributable to the gas and low-carbon energy segment. BP also seeing upstream production, it says, will be broadly flat for the fourth quarter, and oil trading is expected to be weak. And finally, Tesla is shifting gears on its full self-driving feature and how it offers it. CEO Elon Musk writing in a post on X that Tesla will stop selling FSD after February 14th. After that, it will only be available as a monthly subscription. Currently, Tesla owners have the option to buy FSD for $8,000 or pay $99 a month for the service. After that, they'll only have the choice of one of those. Well, we are watching oil prices higher for a fifth straight session as rising tensions in Iran fuel supply disruption concerns. Yahoo Finance's Jay Conley is joining me more on how prices could be affected. And just to set the scene here, President Trump most recently talking about, sort of again, raising the idea of intervening in Iran, telling Americans to leave that country. So this is why some of this speculation has ramped up.
Right. I think you have two parts of this. The first is, of course, President Trump's messaging, telling Americans to leave Iran. This morning, pulling some personnel out of the military base in Qatar, also signaling this 25% tariff on anybody doing business with Iran, threatening action. The second part of this, the most crucial part, is what's going on inside Iran right now, this wave of protests that's sweeping across the country, potentially threatening regime change under the Ayatollah. So there's a lot of uncertainty here, and traders are looking at that and pricing in a bit of a risk premium on oil. You see it up more than 10% over the last 5 sessions as the market wants to really get in and try to figure out where this price is going to go.
Well, again, there's a lot of speculation around it, right? We don't know what's going to happen. So as you talk to people, what kind of scenarios are they sort of trying to figure out and then pricing out?
Yeah, I think there's really 2 scenarios you have here. The first is that this is internal motion. These protests get too large for the regime to contain, and you see something almost a reverse of what you saw in the 1979 Iranian Revolution. The regime topples and there is some kind of power vacuum left open. In that scenario, what you'd be likely to see could be protester action against export terminals, against production equipment. Can the skilled workers get there? Is there power when they get there? The second option here is an external movement, whether that's by Israel or by the US, where the Iranian regime may react defensively. Today from Al Jazeera this morning reporting that Speaker of the Parliament in Iran, Mohammad Bagher Ghalibaf, saying that Iran will set the region on fire if there is US or Israeli action. The big linchpin here, though, is how many barrels are actually taken off the market.
Okay, so put this in perspective for us. How much of global supply does Iran currently account for? And so then if there was some of that supply removed, what effect it would have?
So Iran right now produces more than 3 million barrels a day. They're a very high producing nation. They export around 1.5 million barrels a day. Not a ton, but also a significant enough amount to really move prices if that were to disappear. Analysts I was on the phone with yesterday saying that if it's unlikely that goes to zero, but if it was, it would be an immediate shock to the market. But the thing to watch is how many barrels are actually taken out of export, out of production. If you think back to last year when the US struck the nuclear development sites in Iran, prices jumped on oil for 3 or 4 days and then very quickly came back down because the market read correctly that this wasn't going to escalate, there wasn't going to be a hit to production or exports. Where you see this really starting to push a risk premium higher, oil going to 70 or higher, is if there is serious risk or legitimacy of barrels coming off the market, 500,000 barrels a day, 1 million barrels a day, which would be enough to really swing prices to the upside.
Have we had any indication that the president's threat of tariffs on that oil that's coming out of the country, that's had any kind of dampening effect on demand? It's
hard to say right now because it's so new, but if you think about positioning, China is the biggest buyer of Iranian barrels right now, accounting for more than 80% in 2025. But China also has a trade chip to play with rare earths. So whether that's an effective lever to pull is going to be hard to see. Russia has already come out and said it's going to keep trading with Iran, regardless of this tariff scheme. So you've got to kind of sit and think, these are sanctioned barrels coming out of Iran. Their main buyers are going to be buyers who are okay with buying sanctioned barrels at a discount. So how much effect is a US tariff going to have when those barrels are already on a risk premium?
And the oil operations in Iran are controlled by the Iranian government, presumably.
Yes.
And so if they, if things shifted there, I mean, that's also a significant source of their funding, presumably as well. So if there were some disruption there, that would affect.
Exactly.
I guess it's sort of a circle there in terms of they derive some of their power from those profits.
Yes.
So
yes.
if they're not there, there's a power vacuum. Who comes in and seizes those assets is a question.
And unlike in Venezuela, where you have clear opposition leaders, Maria Corina Machado, Delcy Rodriguez now, there is no clear leader to step up in Iran if the Ayatollah were to fall. So you have a power vacuum where a lot of people are going to be vying for power, which opens up that possibility of, can workers get to the equipment? Is the equipment undamaged? Is there electricity and power running in the country? A lot of those levers could get pulled pretty fast if there were to be a power vacuum, if the Ayatollah were to, if the regime were to topple.
Yeah. All right, Jake, thank you so much.
Thanks, Julie.
Really interesting story. All right, coming up on Yahoo Finance, opening bid, our executive editor, Brian Sozzi, joining us now. Soz, are we pouring one out for Sachs today?
Well, we will pour many out for Sachs today, Julie. I'm really going to dig into that one on the opening bid roundtable. I can't say I'm surprised. Don't know when the last time I've been into Sachs, and I know I'm not alone. Place is just too darn expensive. Maybe not too expensive for you, Julie. Besides that, we got a big exclusive with CrowdStrike CEO George Kurtz. The company has come out here making a lot of big deals, and it's only January, so I look forward to seeing George.
Yeah, I haven't been in Sachs in a long time either, Soz.
Would you tell me if you did?
Yes, of course I would tell you if I did.
No, you wouldn't. No.
Come on. There are no secrets between us, Brian Sozzi.
Come
All right, looking forward to that on Morning Brief. We've got much more ahead on Yahoo Finance. Opening bids next.